Thank you. Thanks. Thanks, and thanks firstly to Kerry for the invitation. If this feels a little bit garbled as we go through, I jump around a bit, I apologise, but I've kind of restructured it after listening to some of the other speakers and trying to avoid overlap, because you've all been now listening to a lot of stuff over the last couple of days, and also where some things were said that I didn't agree with, I thought rather than just sort of make my opposite point, I'd show some pictures that might reinforce why I feel the way I do. I've been in the bullion market for 41 years now. I joined Rothschild as a gold dealer. Yes, I used to work at a bullion bank for 20 years, and no less than Rothschild. And unfortunately, whoever does all the manipulation must have been on a different floor to me, because I never saw any of it. So that's a bit disappointing. But 41 years in the gold market, pretty much living and breathing it every day, helping gold mining companies in particular sort of navigate their risks and trying to figure out how to make money for myself. I describe myself not as a gold bull or a gold bear, but a gold beast. In fact, my Twitter handle is @thegoldbeast. Gold beast because I've made money in bull markets and I've made money in bear markets. And until about 2 years ago, I had lived through as many down years in gold as I had lived up years. So the younger people in the room have only lived in up years. They're full of vim and vigour, and that's fantastic. And that's why you send young people off to fight wars. But, you know, you have to kind of look back and recognise your scars and something. So anything I'm going to say now is it's just one. My ex-wife used to love to say everyone's, you know, like opinions are like bottoms. Everyone's got one. Some people have two. But, you know, this is just my opinion. And it's just my opinion and based on my observations of the way I've developed my thinking about the gold market over the last 41 years. It started from discovering something as simple as the 200-day moving average and applying that to charts and knowing that if something's on the wrong side of the 200-day moving average, you probably don't want to fight against it too much. And Paul Tudor-Jones, who's a lot smarter and a lot richer than me, goes to MBA courses and he says to all the people, I could have saved you the 70, 100 grand and the time you spent here. Just never be short of anything that's above a 200-day moving average, and don't be long of anything that's below it. You know, the market's trying to tell you something. That's a bit oversimplified, but you'll see on all the charts we have the 200-day and the 200-week moving average. We also developed a scoring system that tries to understand when the market's an uptrend and downtrend, so we could say to our clients, you should be urgent about this if it's going down and it's against you, or you should be relaxed. And it's not us speaking, it's kind of a scoring system. So every chart that people have seen me before, red and green background, green means it has a positive weekly score, red means it has a negative weekly score, and the scoring system is the same for every single market, which is good. So it's not about, we're not fitting the past or doing anything else. So the place to start is just the gold market, US dollar gold market. So this is the way we look at stuff. The green, clearly there, is the positive weekly score. Red is a negative weekly score. That green line there is the 200-day moving average. And you'll see in the last the first stage of the bull market, the 200-day moving average was a pretty good guide of the trend. The GFC was really the only time that went below it. Otherwise, it would come back and reconnect and kind of touch. And just when you felt sick, they were the best buying opportunities. And it's been pretty consistent similarly. And we haven't had a kiss or a visit to the 200-day moving average for quite a while, which is why people get a little bit nervous. But look at the table up the top there is interesting, and we'll look at this for $8 gold a little bit later. But at 123 weeks so far for this latest section of green, it's not challenging in time frame. The last three were between 185 and 375 weeks. So this has not run for a long period of time. At 69% so far, it's also not that challenging if you look at the other ones who are 210% gain, a 94% gain, and a 44% gain. But remembering that these things had all gained more at some point before they ended, because you can see in each time when it went back to the negative weekly score, it had retraced. So, you know, 69% so far. This is going to be more than that, or if this is the top, then obviously we might get back and be something like, you know, a 44% by the time we end. Now, this down here is that means it's a positive weekly score. That means the score is 6. Markets that you've got to think about, and I'll talk this more in a minute, that's +6 for a daily and +6 for a weekly. So whenever you see a market here where you've got red on top of this thing and that black line's at the top, that is the buyers go home every day unsatiated, right? That's when you're just in that period of time where your day finishes and you come back the next day and the buyers are there again. And there's not enough selling and the buying has to move them back up to a clearing price. But what you'll notice is when those periods end, you tend to have these hangovers, where once the kind of the orgasm, if you like, of the market is over, there's the rest that's required and the cigarette. So Now, this is my favourite chart of every chart. If I only had to have one chart to rely on for gold other than the gold chart, this would be it. This is the Dow-gold ratio. This is nothing more than dividing the Dow gold by the gold price to show you at any given time for how many ounces of gold you could get for one of each of the 30 shares that make up the Dow gold index, okay? So again, from our scoring system, what you want to know here, if you're a gold investor, red is good, all right? If you're a gold investor, green is bad. If you're an equity investor, red is bad, green is good. So, you know, this is gold underperforming equities. This is gold outperforming. So when you talk about when might I sell my gold, I might sell my gold if I were a US dollar investor, if it got back somewhere here between 1 and 2. For every 1 or 2 ounces I could buy a unit of the Dow, and Dow is real companies with real assets doing real things and earning income, even if that income's in a fiat currency, they're still reasonable assets. So in 1980, if you've been holding gold through the 70s, you got to that point, you know, up here, it would have taken you 16 ounces, between 16 and 32 ounces to buy a unit of the Dow. You could then buy that same unit back for only 1. You'd made 16 times your money by being in gold, right? Now, this period here, obviously, huge retrenchment. Pierre Lassonde really popularised this around here when he bought Newmont. I believe, and I've been talking to our clients for a while, when we came back under 16 is when the market gets very nervous. Now, general equity investors who've got very large pools of money, and this goes back to what Daniel Want was saying yesterday, when they see this happening, when they see gold outperforming general equities, they hate gold, they don't like it, it doesn't pay any yield, you know, they can't value it on some discounted cash flow and all the things they were taught at university and business school. But if it's outperforming substantially, they have to own it, and they will continue to own it until such time as it underperforms. And so all of the people, and I've spoken to a few of these conferences and said the wrong thing. I want to come to Kerry's conferences and other people's conferences at 11 and 12. I said to people, you're getting out over your skis. We think gold's overvalued. I didn't get invited back to some of those conferences because people complained. They said I was sort of killing the buzz. Well, in 2013, I went to a conference and everyone was really angry because the gold price had collapsed. And they claimed it was conspiracy and it was manipulation. But the year before, we'd been saying, hang on, green background, general equities are starting to outperform gold. All those people who hate gold but have been holding it for the last few years, they're going to sell it and go back where they're more comfortable. And that's into general equities. And if we imagine for a minute that we're sitting in the basement of the world financial system, and you know some of those buildings they think it's groovy, but it's just cheap. They have all the piping on the ceiling and everything. If you imagine that all the piping was all the plumbing from every economy, and at the end of every pipe there was a balloon, and sometimes those balloons might turn into bubbles, but if everyone was a balloon and all the money in the world had to flow through those pipes and ended up in one balloon or the other, sitting here you would see where all the money was accumulating, right? The big balloons. When you then push that balloon, and people decide it's time to leave that market and they push that balloon, it's a closed system for a while at least until governments print more money or whatever. It's all going to go flowing somewhere. It has to go to another market. That's what Daniel Want was talking about yesterday. So it's got to fly to another market. Now, somebody in the room who is much more learned in these things is probably going to come up, correct me later, but my understanding generally of fluid dynamics is if you have a pipe that's of this big and you try and move twice the volume through it, it has to move at twice the speed, right? That's sort of a law of physics, that you sort of to maintain equilibrium. So that's what happens in financial markets. You push really hard, it just travels through the pipe at greater velocity. What does that do? That just drives prices at the other end faster and further, and you get those double sixes that I was talking about. So when you see a market like this, like we are right now, Dow Gold squeezing out of equities into gold, tiny market. Gold's a shitty little market in the context of the world markets in terms of the market capitalization and everything else. You get that, you get double negative sixes. So I believe that's the beginning of a trend, not the end. This is not the way trends end. Trends end with orgasmic sort of highs like that. This is the first of these type of things down here. So, and this one over here, very, very similar. But be careful when you look at a ratio, because this ratio can go down because the gold price goes up, but it can also go down because the stock market goes down more. And in this period here, if you were trading gold basis on the ratio, you lost money because gold went down, but the stock market went down further. So it was really telling you should be short the stock market. The stock market halved in 2008. It's hard to remember that. It's $40,000 today. In 2008, it went from 14 to 7. I mean, that's just extraordinary. And then it went from 7 to 40 is even more extraordinary. But, you know, so this is really positive. Now, why do I get so excited about this? For a couple of reasons. Well, one, this is now looking again at the gold price up the top. That's looking at the Dow Gold ratio. You can pretty much see that if the Dow Gold ratio is red, gold is green. Gold does well. If the Dow Gold ratio is rising, gold really, really struggles. And again, you can see it was no conspiracy. It was just flow of funds moving out, going back where they're comfortable. Even here, gold didn't go down, but it really struggled to go up. But when this is red, it gives permission to gold to run, and gold's been doing very well even as this was just flattening. This is the volumes on the ETF. What's really encouraging, and this is not surprising, is with this happening, most of those equity investors, the easiest place for them to put the gold, because like me, they're not paranoid and they understand that all the gold is in the vault of most of the ETFs, that they're going back and buying the gold ETF with a passion like they did in 15, 16, and we all remember that was the end of that terrible bear phase. So investors are coming back. Dollar value, this is the largest ever quarter, not the largest ever by volume, but this is good. This is very good. The fact that gold's been rising without those investors, that's the central banks, now investors are joining in. So that's fantastic. And why do I get even, sorry, go back one. And then the last thing, of course, to this equation is the dollar. Everybody says, oh, you know, dollar goes down, gold must go up. Well, gold's been going up like a mad thing, and the dollar has been going up for 11 years as well. So gold can go up against a rising dollar, and that tells you something. And Barry, I think, believes the dollar can keep going up alongside gold. I hold very firm opinions very loosely. So I'm on, right at the moment, I'm in either camp because we're right at the neutral point. And in fact, dollar has still got a green background, so I have to believe at this stage that it's still an uptrend based on our scoring system. I can see how that could change. So that's the dollar, and there's the Dow Gold, right? So I'm going to really simplify watching gold for you. And I wish I'd had this chart years ago, but this is something that developed in our thinking as we were thinking about it. I said to one of the young guys in the office, can you just make the line on the gold chart red where we have the situation where the US dollar is rising and equities are outperforming gold? That's green background on the Dow Gold. So green on the US dollar chart, green on the Dow Gold. Show me what was happening with gold. You can see there by just not being involved in the gold market, whenever it has a red, when that line is red, you would have been much better off, and you wouldn't have been one of those people claiming conspiracy theories around about here and feeling very bad and holding on and just getting worse and blaming everybody else. If you combine that with the 200-week moving average, if you're investing for your grandchildren, as I'm about to start doing, or for yourself, maybe by using the 200-day average, looking at the average age of people in this room, we need a bit of a shorter time frame, then... Including himself, absolutely. Absolutely. 62 on Anzac Day. So you know, those two things combined, you just stayed away, right? Like, you just don't have to play. Now, this is the other thing. Gold bugs feel the need to be in gold all the time. Rational investors realize it's one place that you put in your portfolio. You might always have 5 or 10% in your portfolio, and there's times to add. But clearly here, why? Like in Australia, you learn, don't swim against the rip. Right, you're going to drown. It's going to outpower you. Swim to the side and then come back ashore. It's the same here. Now, what's even more exciting, this is the chart that I show my gold mining clients, our gold mining clients, because they're always bullish, but they've got huge capital costs and they can't run away. They can't run away in a bear market. They have to live through it. And they have to have people ringing up like the poor guy from Challenger yesterday, telling it a puppet could do a better job than them running the business and all the rest of it. But for the people in this room, I've got a special treat for you. That's when you have dual headwinds. That's when you have dual tailwinds. That's when you have a red background on the US dollar index chart and you have a red background on the Dow Gold ratio, right? When gold is outperforming equities and the dollar is trending down, it's rocket fuel for gold, or it has been historically. And you can see again that whole move, right? You had one little tiny touch of red very briefly here, but really that's it. Now, what's also been very exciting lately, and that's just an expansion of that, we actually broke to new highs with a red background. And I said to our clients, and some of them think this is woo-woo, but that's really interesting. Like, gold has broken out to new highs, and yet it's got dual headwinds. So that means there's something else happening in here. And that's when everyone was going, oh, it's wrong, the market's wrong because real interest rates are going the other way. Well, of course, we all now know everyone's got a reason and can explain to you why it's broken down from real interest rates. But The fact really was that central bankers, who we don't like, but we seem to do like, don't we? Because they're all buying lots of gold at the moment. So we like them when they're spending other people's money buying gold, even if it's ours. So anyway, that's the thing. So that's dual tailwinds. So to me, that's very exciting because we're not even green yet and we're strong, but we're just inches off getting green because you remember that chart. One is red with a negative 66. That's not going out of red for quite some time, the Dow Gold. But that could be all about the Dow Jones starting to fall quite dramatically in the S&P. But if the US dollar just goes back through that level and turns to red, then we have rocket fuel, as we had for this whole period here. Now we'll talk about the dangers of that rocket fuel at the end of the cycle a bit later on, hopefully. Now, bond yields is the other things everyone's talking about. There's the bond yields. That's only going back to the year 2000, only the year 2000. For the 20 years before that, it was also falling. So this was a 40-year bear market. So think about gold got to 400 after a 20-year bear market from 800, and it was hated and reviled. No one in their wildest dreams, if I'd stood up here, any of the speakers had stood up here and been as bullish and effusive in 2001 as they are today, you'd be looking at them and going, well, on what basis, mate? Right? Because it had been a 20-year bear market. But the seeds, as Rick Rule likes to see, the seeds of every bull market are sown in the bear market before it. So it was coming. Now, I think that you've got the chance that a bull market and interest rates, whatever we think governments don't want, they don't really control the interest rate market. The international capital flows do. This is a bit like gold at 600 after coming off the 250 low or 400. This is the first little rally of a very long bear market. Now, it was mentioned earlier the idea that you never sell your gold, you borrow against it. Well, in 1980, and I'm sorry I don't have the data going back with our scoring as well, but the gold price went up in 1980. This is gold versus bonds. Gold went to outperform bonds by 5.5 times to the high in the 1970s. The people who made the most money out of being long gold in the late 70s were the people that then went out and bought government bonds. Because government bonds were paying a real yield, they were paying fantastic interest rates, big double digits, teens, mid-teens, and you project off that, you go back and look at 800 and you think people held onto their gold at 800 and didn't let go. You either had to borrow money at double-digit interest rates, or you could sell the gold and invest your money at double-digit interest rates. And yes, it's fiat currency, but fiat currency paying a proper yield in a different environment made enormous sense. And bonds outperformed gold all the way to 2001. Now, I don't include this in our chart, but it's interesting that also around that time you will see, if I had three factors, gold outperforming bonds was also one of the principal things here. So everyone knows about the 60-40 portfolio. The whole idea is you have 60% equity, 40% bonds. If your equities are losing, you're making money on the bonds. Well, if you start to lose money on equities and you're losing money on the bonds, that's a problem. Where do you go? Well, you go to gold. So gold outperformed here. Now this market, gold is outperforming bonds again, and it broke this high. And a lot of people only show you charts that go back to there. That's why I like long-dated charts. If you were looking at a chart that only went back to 2000, you'd be going, gold, oh, it's way out on its skis versus bonds. It's here, and if it's a 1970s type environment, it could go another fivefold, and it wouldn't even be unprecedented. I mean, it wouldn't even be a black swan event because we've seen it before. So gold versus bonds, that's a very strong trend, and it's going. And if we have time to talk about gold and wages at the end, maybe in the question time, this is a very interesting thing because I've heard some interesting theories about what could happen here and that governments basically are going to turn on corporations and really face back and realise that we vote them in. Corporations might entertain them and pay them lots of money and give them lots of campaign donations, but we vote them in and out. And we're pretty pissed off and we don't earn enough to buy enough gold or enough house or all the other issues. And we could see wages, which obviously will feed inflation, but at the end of the day, if you're getting paid more, then you can deal with higher interest rates. Because one of the reasons that we've been sort of sucked in the last few years is we've had low wages, but we had cheap stuff from China and we had low interest rates. And then some of us let our children go out and borrow far too much money at 2% and not warning them that it could go to, not telling them it could go to 6, let alone 18. But anyway, so other ratios of gold, gold-silver ratio, people have talked about that. The gold-oil ratio, that's one of the reasons mining companies are so profitable at the moment. And Brian Wu, who writes a wonderful newsletter, has talked about this. This is really like it's really a bit of a sweet spot for miners. But again, that's sort of interesting. Like if you're thinking about it now and someone's thinking about selling some gold stocks to buy oil stocks or gold to buy oil stocks, may not be a bad idea because it seems to me like oil's being trashed in the narrative and oil's probably far too cheap because the world doesn't look like it's getting any simpler to my mind, and oil's always been the geopolitical asset. There's the Dow Gold again. Now this is the other really interesting one. This is a gold conference, but what is a bit concerning if you're a gold investor is that gold relative to a basket of commodities, as represented by the GSCI, which is about half oil, gold's as overvalued relative to a basket of other goods as it was in 1980. So gold is cheap relative to bonds and it's cheap relative to equities, but it's not cheap relative to other commodities. And I think that's a signal that's being sent, and for a broader conference, that broader commodities have been underinvested for a long time. And if you think about the dot-com bubble and how cheap commodities were at the end of that, and now we're at the AI bubble or balloon, and you're at the end of that, we've underinvested. And that wonderful senator yesterday talking about how kids said mining's dead. Well, if mining's dead, the whole world's dead because nothing gets done without mining. This building doesn't get built, this doesn't get made, nothing gets done without mining. We've underinvested mining for a very long time. The only thing that scares me is governments have decided to get involved in mining, and that we know how that ends. So anyway, there's going to be a lot of projects built in Australia that shouldn't be, while other projects that should have been built are not because the government didn't approve them, while one of the other parts of the government is approving some critical metal mine that's above the right latitude. But enough of that rant. So Aussie dollar gold, because that's more interesting, and I do want to try and get to questions. Aussie dollar gold in the same picture as US dollar gold is a different picture. You have, if you've been long this, you have benefited. You have benefited from a falling Australian dollar because you sold Australian dollars to buy gold. So you essentially took your money out of the country without taking your money out of the country and bought gold. Now the concern for me in the short term here is, if you look at this, 132 weeks of $8 gold, we're starting to get up into the type of lengths that, have been challenging. And if you look here, this is now the biggest rise by a country mile out of those, right? Now, some of these were a lot higher before they ended. So I think that one was about 96% before it ended. So the idea that we might, in 50 weeks from now, find ourselves, having retraced, 30% and be back at the awful Australian dollar gold price of 3,700, it'll feel painful if you paid 5,100, but mining companies will still be very profitable and it will still be a very good long-term gain. But so $8 is a bit more challenged. Now, interestingly, $8 at the moment is double sixes, right? A bit like it was here. I think the big challenge now is to figure out if we're closer to 2006 than we are to 2011. Given we haven't yet had the equity market crash, my money is we're closer to a sort of a 2006 type scenario in the lead up. And remember, $8 gold actually did really well in the GFC because gold fell, but the $8 exchange rate fell further. So $8 gold actually went up while US dollar gold was going down during the GFC. So it's maybe post-crash that'll be the issue. But so that's then the scoring actually overlaid. So those red dots are when the scoring is +6 at a weekly time frame. Again, just draw your eye across what happens when these end. This is now the longest one, or coming close to the longest one. So we shouldn't be surprised if we have a period of retrenchment or sideways to kind of get back to a more reasonable angle, which is why my granddaughter Clementine, who's 6 months old this week, before she was born, I said when she's born I'm going to buy at least 1 ounce of gold every year to give to her when she's 21. I've changed my mind. She's going to get 100 ounces of silver in her first year going into the account because of the ratio, because of that, all those red dots. And I believe at some point 70 or 60 of those ounces of silver, I'll buy 1 ounce of gold and I'll take the 40 back for Granddad and we'll be square in the account. And she'll be none the wiser unless one of you tells her. I'll know. If she finds out, I'll know who it was. Now, just on the $8, and it's purple here is when the Australian dollar has a red background in our scoring and the gold has a green background. We tell our clients that's purple patch. That's the best possible time for $8 gold, and people have been saying lately maybe the relationship of commodity currencies is broken down. Maybe it has. Or maybe we're just very late in the bear cycle of commodities and that's going to change. But I just ask you to draw your line across the highs made in every one of those periods of purple patch. They are very significant insofar as they tend to kill the buzz for quite some time thereafter. But when they're broken, the market goes very strongly. So I was super excited when gold went through here for that reason, because we broke the previous purple patch high, as we did back here. But some of these dominated for 20 years. So, I say to our clients, it could be the case that in 5 years' time, the US dollar gold price is 70% higher and the $8 gold price is unchanged. And that wouldn't be unprecedented. That happened in 2001 to 2006. Now, that's the Dow Gold Ratio Australia version. That's the All Ords versus Australian dollar gold. You can see that gold is much stronger relative to our All Ords, but that's probably not surprising because we've got a lot of BHP and Rio and stuff in there. So we're a very different market to the US. But you're getting closer to where might I sell my gold? Well, historically, and certainly in 1980, the idea down if you could get, for half an ounce of gold, you could buy a unit of the All Ords. Maybe that would make sense. And here's an interesting thing, because I think any comparison that someone does about money in the bank versus gold is it's not really real. Because I don't know, I don't know a lot of people leave a lot of money in the bank at current interest rates, or people seem to be more invested in their super in shares. Everyone loves CBA, right? So your mates, if you're trying to talk them into gold, maybe this is a good chart to show them, because gold outperforms CBA. And everyone thinks that CBA is like the rock star in the market of the kind of more conservative things. That's the gold. That's CBA share gold price divided by the CBA share price. And so these slides will be available. You can look at them better. But one of the things you would realise again is like periods of time, like the global financial crisis. If you had some gold, the idea that you get up to you can buy 60. That's a log scale, by the way. You could buy 60 CBA shares for an ounce of gold, where previously you could only buy 15. That's not a bad reason to sell some of your gold and buy some CBA shares. There's a lot of other things you can do that are real things that you can do with your gold. Now, this is a fascinating chart to my mind, because this is gold equities and the indices. Now, I'm all for the gold ETF. I'm all for the gold ETF. I have no problem with it. In the long run, I'd rather have physical, but in the short term, it's a good place to own gold. But gold equity ETFs, I think, stink. And I think they stink because they just lump a whole lot of companies together into an ETF, and just some of them just because they're big. And the one thing I know about mining companies is big is bad, generally, right? The bigger they are, often the badder they are. Newcrest being the perfect example, God rest their soul. So you'll be able to show me lots and lots of shares that have outperformed gold in recent time. And I have some sterling ones in my portfolio, some to the great advice of Barry in the front row here. But there's been some amazing successes. But as an index, the index, red here, has been underperforming gold since 21. And it underperformed hugely in 13-15, as you would remember, because they all had to raise money because they couldn't make money selling gold, even though we were all bulled up back here. So this is an interesting thing to me, because I believe this is about to break. And if you look at those ETF volumes, they come first. They always do. They go first into the ETF. But the big generalist investors, they're rational. So they're not going to buy gold equities if gold equities aren't performing gold. Why would you? Why would you buy any gold share that's not outperforming gold? And you know that they underperform gold massively if you get it wrong and gold's going down. But if we pop our head up here and the ETF volumes then flow over into gold mining, so then it's on like Donkey Kong. So that's pretty cool. Now, interestingly, again, if you go to individual shares, like Northern Star, that's not about gold. That's about very slick businessmen being in the business of mining gold and building a gold mining business, all right? Because you can't even see there the troubles of 13, 14, 15. Northern Star, you could just buy more and more. It took you fewer and fewer Northern Star shares to buy your gold back. Up here you could buy 50,000 Northern Star shares for an ounce of gold. Here you could buy your ounce of gold back for 800 of those shares and keep the rest for free. All right, so that's the thing when you look at these mining companies. It's about buying into good businesses, another good business evolution. But these guys have been underperforming, and Bill Beamer might like to say that Evolution hasn't done well. Northern Star hasn't done well because he left. I would say he left because he realised it was going to stop being fun. Because once you get to a certain size, even just matching the gold price after you pay dividends is tough, right? So you've got to remember that. And that's just those on our scoring. And I wanted to show you that because this, again, is about when investors change their mind. This isn't about Jake Klein. This isn't about Bill Beeman. This isn't about Jake Klein or Bill Beeman. This is about investors made decisions to move capital to another place, and all the money moves and everything. They squeeze one balloon and the other balloon has to pop somewhere, right? So that's what that's about. That's in Japan. That's their ratio. Same thing. They love gold. Gold was the thing that saved them after their bubble burst in '89. But again, it's getting to the point where even the Japanese love of gold, we get down here, we're there. And if we go then to China, and they're one of the largest private holders of gold in the world, it's getting down to bargain basement territory for their commodities relative to thing. And if we see that change, I can tell you, gold has very rarely gone up in those periods of time where Chinese equities are outperforming gold because the Chinese then favour that. Now, all of this is important in terms of these behaviours is because whatever you think about what's happening, there's a whole lot of other people that own gold that are driven by what's happening to the yen or what's happening to the Indonesian rupee or the Australian dollar. So the gold won't just do everything to do with US dollar. The US dollar might affect all those things, but there's a lot of other people with different motivations of when it might be their time to sell gold. And I'm sorry I've chewed up all the question time because I'm just about to run out of time completely, but if I could end on this chart, it's a bit confusing, but it's important. So the blue line is the US dollar index, which we saw before. That's the US dollar, that's simple. This red line is the ratio of the Goldman Sachs commodity index to equities, but it's been inverted. So that is equities outperforming real things. Equities outperforming real things. This is then real things outperforming equities. This is the China being led into the WTO, the commodity boom of the 2000s. And they generally always end in some kind of peak crisis. They base out and they end in a crisis, right? And if you just look, the interesting thing is tops in the US dollar. This is the Plaza Accord. That's fine. Weaker dollar is good for the US. Eventually, when the dollar gets too weak, the world has a problem and it kind of blows up because we're so reliant on the dollar in one way or another. Now, we're a long way from that spike, but this dollar rolls over here, the idea that broad commodity basket would go up. And again, gold is kind of telling us that something big is happening, but we need to reinvest in real things. And if you think about the armaments industries and all the other things where we think we need to reinvest, that all requires metals and minerals. America needs to rebuild their electricity grid if they're going to get to halfway of their amazing plans for electrify and everything else. So we need more real things. We need more mining engineers like the young kids were up here at the beginning. But real things is going to come back in fashion. Gold is only one of the real things that you might choose to invest, but at the moment it's still the best real thing to invest in, and watch those ratios start to change. When the gold-silver ratio starts to fall, gold-oil ratio starts to fall, that might be the signal that other things are going to outperform, but at the moment gold's outperforming everything. So again, that's kind of just the framework that I try and use. You didn't break it down to a level. I think with regard to equities, I've come to the conclusion I'm better off to give my money to people who understand these juniors better than I do. So give a shout out to like Lion. This is not investment advice, but like to Lion and Lowell, for example. I buy their shares on the ASX. I tell my kids to buy their shares because they're much smarter than I am. They have all the things I like and none of the shit I bought. So, but you find the people that work for you. But again, a lot of these juniors, you'd be better off to have a diversified portfolio run by someone who really knows what they're doing. Otherwise, like me, you're going to be mesmerised by some of these geological charts, and it looks so easy to turn those red circles into gold bars on the surface, and you can do it and making a profit, I've discovered, is a lot harder. So anyway, so that's it from me, and I'm sorry I've chewed up the question time because I do like to answer questions. But cheers.
A couple of questions.
Sorry, Bob.
Absolutely.
Any questions? Sorry to the next speaker. And cramming lunch. No questions.
You've amazed them.
I'm sorry? Oh, so Lion Resources and Lowell, they're both listed on the Australian Stock Exchange. One's a trust, Lowell's a trust, Lion's just a listed company, but all they do is invest in junior explorers and mid-tiers and emerging companies. So you buy one share and you've got one proxy form and one lot of paperwork, and you get exposure to 10 or 15, and like the pre-IPO stuff I find particularly exciting because I know if someone comes to me and offers me a pre-IPO allocation or something, all the smart money rejected it. But if it gets to me, like I'm way down in the filter, right? So they go to Lion and Lowell first, and if they say yes, they know when they IPO, everyone go, well, Lion and Lowell, and I'm going to have some of that. So, but those people don't give away their brand lightly, and they're very clever, and they've both been through the cycles, and they've got some old people there with no hair and some young people who'll walk through walls, and you need that combination, right? So that's why I like them. There's others, but they're the ones I like. So not investment advice.
We've got a question at the back. Yep. Or where are we going?
Yeah, hello.
Over here.
Yeah, look, just that was great information, but I did get a bit lost in it. Are you saying to buy or to be cautious?
Well, you should. What I'm saying is you should have bought before. That's what everyone said, didn't they? You should be you should be long, son. That's it. No, what I'm saying, I think, is we're in a gold bull market, and we have single tailwind, and we could have a dual tailwind. So that looks fantastic. Would I be going if I hadn't been involved in gold shares before? Would I be going into gold shares over gold? I think I'd be going into gold. I think if you're going to get into gold for the first time, you should get in slowly. You know, like any market, you put a little bit in, you're comfortable, buy some more. Again, it depends on your time frame. As I said, like it's easy to make decisions for my 6-month-old granddaughter Clementine if I've got a 21-year time frame. I hope I've got a 21-year time frame too. But, you know, I've got to think differently about, you know, what I would do with my money or the risk profile I would have. And I think it's different for everyone. But gold relative to general equities, absolutely. I mean, you know, the idea of having some in your super fund, you know, having an allocation, absolutely. One of the things that scares the crap out of me is every time we put our money in our super every week, they sell about 30% of the money we put in or 40% of the money and send it overseas. One of the reasons the Australian dollar is so depressed is that Australian super funds are selling the Aussie every week to go and invest overseas, and they don't hedge that. Now, one of the things that's quite interesting, I think we need to watch for, despite all the very negative sentiment out there about everything, is that if the super funds decide they need to hedge some of their currency risk, not bring those portfolios back from overseas, but actually hedge out the risk of the $8 going up, if we start to see a flow of funds into commodity countries and commodity currencies, that's just another, you know, buyer that would be in there, along with the fact that commodities are worth more and they're selling more. So, you know, we're, as a nation, we're actually short our own currency quite a lot. I mean, as individuals in our super funds. I don't think people are fully aware of that.
I think we've got time for one more question, depending on how long his answer is.
He's fast. Thank you. It was a great presentation. And that was kind of my question about the Aussie dollar. So if you're Australian and just investing in Australian shares, we'll get even though the gold companies won't be as profitable if the Aussie dollar gold just stays the same, we get a boost of outperformance, because is that when the international money comes in and they want Aussie dollar gold because they're gaining on the currency?
It's really interesting, because sentiment is all driven by the US dollar price, right? So that's sentiment is driven by the US price. We need the US price to be higher for all gold shares to run. That's what attracts the global capital in. Then the guys get the global capital. They look around the world for the best mining companies with the best margins, and they find them at the moment in Australia, right? Which is great because our gold prices run so much harder. So that's the best value. But at some point, if the Australian dollar starts to go up, those overseas investors have an interesting thing where they'll be long the Aussie. They will have sold US dollars to buy Australian dollars, so they'll be long the Aussie. That's a good thing. But they'll see that the profitability of the Australian company starts to flatten out. Well, back in America, the profitability of the American companies is now going up if the US price is going up and the Aussie's going up at the same time, and Aussie dollar gold is going sideways. But the $8 companies will still be very profitable. And if you're an Australian investor, if the $8 stayed at the same price as it is now for the next 5 years, owning Australian gold mining companies that pay good dividends would be a fabulous thing, because as good as the Australian mining industry is at getting their costs to get closer and closer to the prevailing spot price, I think they're challenged to get it anywhere near 5,000 in the next 5 years, right? So they're going to have really good operating margins. So if it just stays the same, that would be fantastic. Like, you don't need to be bullish on $8 gold to be very bullish on quality existing mining companies that will regularly give you money back in dividend. They'll be some of the best performing stocks on the ASX in the next 5 years, in my opinion.
Thank you.
Ladies and gentlemen, please thank Sean. Amazing, as always. Thank you, sir.
Sorry.
Oh.
There's a slide there, I'm sorry. And you can get this, Kerry, how do the people get this? These are the free things,
Take
that
photos.
I read. I love this. And also, I'm sorry if you've jammed a lot into small information. There's a presentation, a longer version of that presentation on our website, which is there, and our thoughts that you could go and have a look at. So it goes for about 45 minutes. But all of those things are free, and 90% of everything you need is in that stuff. There's some really fantastic information there. So I encourage you to sort of subscribe to those things and read them, and that costs you nothing. So thank you.